Good afternoon, everybody. Tuesday afternoon after the market close, and I've had a couple of up days after what was a rough January, which has gotten a lot of the pundits talking about the January barometer. January barometer this, January barometer that. There's all kinds of indicators on Wall Street. There's head and shoulders patterns, there's island gap reversals, there's the January effect, there's the Santa Claus rally. Usually this stuff is just a bunch of gobbledygook. But in this case, I think the January barometer might be worth paying attention to. What the January barometer shows over history is that an up January generally precedes an up full year, whereas a down January generally precedes a less good year. Not necessarily a down year, but a year. The median rise for the next 11 months is 0.28% in a down January versus up 10.4% in an up January. So there's something to it. And especially this year, I think it's significant because of the incredible character of last year's rally. What you have to understand is that going into the end of last year, a lot of managers were sitting on a lot of profits. Now, a lot of these managers' compensation is tied to their performance. So they have a huge incentive to keep that performance good through year end, especially hedge funds, which get 20% of the profits. So these managers are likely to continue with what's working until year end. They can collect their 20%, and then in 2010, it's a fresh slate. The performance chase begins all over again, and so what you see is a repositioning based on their objective view of the market prospects, rather than them just trying to ride out a year and hold on to their profits so that they can get paid. So that's why I think this year the January barometer has some validity, and that the fact that the S&P was down 3.7% might tell us something about the rest of the year's trading. Not only that, but the securities that compose the so-called risk trade were actually hurt worse than the overall market. For example, in the 8 days ended last Friday, January 29th, the MSCI Emerging Markets ETF, EEM, was down 10.56%. The Brazil ETF, EWZ, was off 13.31%. Goldman Sachs was down 10.87% over the same period, and Alcoa was down 18.50%. So what you're seeing is, a real quick reversal in stocks that have been excellent trading vehicles and that have just been up in excess of the overall market. Not only that, but the volume continued to remain strong on the sell-offs last week. In fact, the 4 biggest volume days of the year have been 4 of the worst days of the year. So you're seeing conviction on the selling and not as much volume on the rallies, including the 2 up days this week. Overall, this all amounts to a real change of tone in the market. And I think what I'm trying to tell you guys is Top Gun is back.